Investment appraisal for A-level accounting. What is investment appraisal? Well, obviously we need to invest in a variety of non-current assets which will be used over a long period of time in order to generate a profit for a business. When you're deciding which non-current assets you need to buy, you need to obviously make this decision very, very carefully. Firstly, because it's usually a very large investment that is being made into these assets. And secondly, because you intend to keep it over a long period of time, it means that that cash or money that you've borrowed, the investment will be tied up for a long period of time. It's quite important to get input from all the parties involved. You don't really want to have just one person making the decision. Obviously, you need to have the financial manager on board to see if there are finances available, but you also want to get input from the people who will actually be using the asset. They very often will have valuable information to mention that what needs to be considered if a certain machine works better, if it has a certain characteristic, etc. So you need to consider a number of things. Obviously, the cost is the most important one, but you don't always want to just go for the cheapest option. And although all the different appraisal methods that we're going to look at in this section do actually focus on the costs, as well as the revenues that it will earn, you also want to look at things like the lifespan. How long is this asset actually going to last, or will you need to be replacing it very soon? You want to look at the quality of the item. Are you going to need to repair it very often, and what will that cost? You do want to consider the potential earnings, which we will take into account when we look at the different appraisal methods, but you also want to consider the impact it will have on employees. Does it make their work easier or more difficult? As well as on the environment, especially as these days we are becoming more and more concerned with the sustainability of the earth around us. We do not want to buy something that is going to have a detrimental impact on the earth. So let's now have a look at different appraisal methods. The appraisal methods that we will use are going to compare the changes in cash flows or incomes and expenses, depending on whether we're looking at profits or cash. However, we're just looking at the changes. So what I mean by this is if you have already made a particular investment, that is known as a sunk cost. You will not recover it no matter what you decide to do now. In this case, you need to ignore those costs. So the costs that have already been incurred or will still take place no matter what you decide are not going to be factored into the equation. We also need to have a look at the opportunity cost. Sometimes there is a cost that we would have to pay in the sense of if we decide to buy one asset, maybe we need to forego buying a different asset for some other purpose. We need to then factor in what are we losing out if we are not able to do option B that we would have liked to perhaps do. In other words, what is the benefit that we are going to have to give up if we make alternative choices? When choosing which investment to invest in other words, what project to undertake or what assets to buy, we need to consider both the cash impact, how much cash will we have to spend now, and when will cash come back in. And remember that cash inflows and outflows are not necessarily the same as the profits that we will earn. The profits and the expenses do need to also be considered, as do the return on investment and the time value of money, which we will go into in a few slides. The first and most simple method is the payback method. This is a very simplistic way of looking at it, and it doesn't factor in all the things that we've considered. However, it is very easy to calculate. It is cash-based, so all you need to do is look at the cash outflow now and the cash inflows that you expect over the next few years. You then calculate the time period in which the cash outlay is recovered, and this is done very simplistically. In other words, you look at how much is coming in year 1, add it to year 2, add it to year 3, until you have recovered all the cash that was outlaid in the first place. This time period is then what is going to be compared, and generally you would choose the one with the shortest time period, as this is the most favorable. However, this doesn't factor in sometimes an asset will take a little bit longer before it's able to generate incomes. However, those incomes might last for longer than another option. It is, however, very easy to calculate and therefore can easily be used by people who don't necessarily have an accounting background. It doesn't consider the profits nor the time value of money. So let's have a look then at the accounting rate of return instead. The accounting rate of return, otherwise known as ARR, is based on profits. So if you are looking at what is the profitability rather than just cash flows, this is a good one to use. It is very similar to our return on capital employed, as it also compares the profits that you will receive to the investment that was put in the first place. And so accountants will understand this very well. Remember that when you are comparing things, it's very useful to use the average. Now, if we are looking at the accounting rate of return over a number of years, you want to look at the average profits and compare it to the average investment. When we were looking at the return on capital employed, you would take the profits for a particular period, so 1 year, for example, and you would then compare that to the average investment or the average capital employed for that time, in other words, equity and non-current liabilities. To work out the average equity and non-current liabilities, you may remember you would have needed to look at the figures at the beginning of the year and the figures at the end of the year. You add them together and divide by 2 because you've used 2 figures, and that gives you the average for that period. Because the profit was for this entire period, it made sense to compare it to an average figure for that same period. In this case, we'll use the same idea, but if we are going over a period of, for example, 5 years, you will also need to work out the average profits over those 5 years. In other words, you would take the profits each year, add them together and divide by 5 if you've used 5 different years worth of profits, and then you would compare that to your average investment. For the average investment, you would simply take your initial outlay at the beginning of the 5-year period, and then you would say, what is it worth at the end of the period? In other words, probably this will be what the trade-in value is, and you will average that. In other words, add those 2 figures together and divide by 2. So your accounting rate of return is going to be your average profit divided by your average investment. Keep in mind that some assets may require you to also invest more in working capital. For example, if you buy a new machine to make a new product, you're going to need to have more stock of raw materials, etc., going through that product, and so therefore working capital will also be needed. So you would need to include your working capital. Because you would assume that usually the working capital would stay the same for the beginning and end of the period, the average will actually just be the same amount. So you could either include it in your total investment at beginning and end, or you could just work out the average investment and then add the amount of working capital that is in existence each year. The net present value is another way of looking at it. Hopefully you can see that each method we are looking at is getting a little bit more complex. The accounting rate of return was great because it looked at profits rather than just cash. The net present value, however, looks at cash but takes it up a notch. You need to keep in mind that money becomes less valuable over time. This is known as the time value of money. Obviously, inflation is part of the cause of this. If you think about what you could use your money, your pocket money as a child, you may have got a very, very small amount of money and you could have bought lots with it. These days, you would be able to buy very little with that same amount of money. However, the other reason that we say that money becomes less valuable over time is that if you invest an amount of money or you borrow an amount of money, the value of that money grows in relation to the rate of return or the cost of the capital. In other words, the interest rate that you are dealing with. So any amount of money that is invested or borrowed now will have a much higher value in, for example, 5 years' time, as the interest is added over time. This means that what we can do is we can actually look at what is the future value of this cash item. So if you look at a cash inflow in 5 years' time, instead of saying, oh, that is the cash I would receive now, it's not. Look at the cash in the future, but discount it. In other words, just like to work forwards from present day, you would take an amount of money and you would times it by 1 plus the percentage. So for example, if it's a 12% interest, you would say times 1,12 to find its value after year 1. And then for year 2, you would take that value after year 1 that you've just calculated and times 1,12 again, and then times 1,12 again for year 3. We can do exactly the same thing working backwards by saying, what is the value at the end of year 5? And divide by 1,12, divide by 1,12, divide by 1,12 until you come back to year 0 or now. And this is what we will do to find the present value. What we call this is discounting. We'll say that the future value is discounted to find the present value. All I mean by that is that we are dividing it by 1 plus that percentage of interest to find the present value. In other words, we are taking the interest into account. So we discount it using the cost of capital or the interest rates, as I've just explained. We'll then compare the present value of these future cash flows to the initial cost of the investment to see whether or not they are actually greater or less than the initial investment. At first glance, it might appear that the future values are going to be much higher, but as soon as we discount them, we might find that the inflows are actually at net present value. At present value, they will be lower, and therefore the net cash flow will be less than 0 or negative. It's possible to use a financial calculator, or you could be given a table, or you could even create your own in Excel if you need to calculate present values at different rates. All that these tables or the financial calculator do is what I was just doing here, where I say keep dividing by 1 point the percentage until you get to your present value. Your discounted payback is now factoring in your payback, which we liked because it was very simple and considered cash, but we're making it more realistic by discounting. We combining the payback and the net present value. In other words, we look at what future cash flows are predicted and we discount them in order to determine the payback period. So it's very similar to our net present value. For the net present value, we simply see, is my initial cash outlay going to be bigger or smaller than the present value or discounted value of all my future cash inflows? If my inflows are going to be greater than my outflow, but at discounted value for present value, then it will be profitable, and we'll factor that in. Discounted payback is very similar in the sense that, again, you are going to discount your future cash inflows, but you are then going to consider the time period for the payback of these cash flows, but at a discounted value rather than the real value. The last method that we are going to consider is the internal rate of return. This one is a little bit more complex as it takes into consideration both the rate of return or the interest and the time value of money. In other words, when I'm considers the return or the profits, I should actually say, as well as your time value of money. So in a sense, it's combining your accounting rate of return and your time value of money in a sense, and then comparing that to your interest rates or your cost of capital. However, the formula is a little bit more complex, so don't think of accounting rate of return, although it is related. You need to understand that if your percentage return equals your percentage cost of capital, in other words, your profits divided by your investment equals your percentage interest, then what this means is that your cash outflow at the beginning should equal the present value of your future inflows. In other words, your net present value is going to be naught. Okay, but this is obviously it's kind of like a discounted interest or discounted profits in a sense. So what you're going to do here is you're going to say for the internal rate of return, it's taking into account the time value of money, and it's saying what is my investment actually worth and what is the return that I'm actually earning if I go backwards. Now the formula is a little bit confusing perhaps, but what you do is instead of going by trial and error and finding out where your net profit value is going to be naught at what rate, instead what you do is you choose any positive and any negative rate of return and see what the amounts would actually be. So we choose any net present value or any interest rate where the net present value is going to give me a positive answer, and that rate I'm going to plug in here for my capital letters P and N, and then I'm going to choose a percentage where my net present value is negative, and I'm going to plug that in for my N's. The capital letters here are for the percentages, and the small letters are for the values of my net present value. So in other words, if I, for example, am able to work out that I will have a net present value of positive 500 at 10% and negative 200 at 15%, over here I'm going to put in my positive, which is going to be 10%, plus 15, which is my negative result, minus my 10, which is positive, so 5, times my values. My positive value was $500, and over here my positive value is $500 and my negative of $200. And what's happening here is we're looking at the difference, but because it's a double negative, it actually becomes a positive. And using that rather complicated formula, you can then work out what your internal rate of return actually is. If your internal rate of return is larger than your cost of capital, in other words, the interest that you're paying on a loan, then your project would be considered profitable. The last thing that we need to look at is sensitivity analysis. Sensitivity analysis quite simply says the future is uncertain. We don't know what is going to happen. And all this planning that we have been doing, all these appraisal methods that we have been doing calculations for, are based on our guesses, our best estimates of what is going to happen in the future. And although we might have an educated idea of what the future holds, we don't necessarily know that this will be the case. And since the future is uncertain, it's a good idea to understand how our outcomes are going to change if the variables change. You need to keep in mind that as soon as the net present value is naught or less, your project is no longer going to be profitable. Because remember, the net present value is saying my future cash flows at present value need to be bigger than my initial cash outflow. And if that is not the case, it's not worth doing the project. We also want to make sure that the internal rate of return is bigger than the cost of capital or the interest rates that we are paying. As soon as this is not the case, in other words, if our internal rate of return equals the interest rates or is smaller than the interest, it is no longer going to be profitable. So for any project that you are looking at, you need to look at the answers that you are getting for things such as your net present value, your internal rate of return, etc., and see how close they are to 0 for net present value and the cost of capital or interest for the IRR. And the closer they are, obviously the riskier it's going to be. You can also look at how sensitive it is. The greater the sensitivity or the closer it is to these items, obviously the greater the risk of something going wrong and the project becoming unprofitable. In reality, there are generally a number of variables, and although you might look at only one or two of these, there might be a whole lot that actually change. So keep this in mind, and you need to look at the bigger picture, not only the numbers that we are looking at here. However, these calculations and appraisal methods certainly go a long way to helping financial managers make suitable, profitable decisions.